Good evening, class, and welcome to our advanced taxation class this evening. Our topic for today is double taxation arrangements. Now, in this class, we will be talking about tax treaty and double taxation relief. You will be hearing things like Commonwealth income tax relief and double taxation agreements. You'll be seeing the benefits of having a double taxation agreement, Nigeria having double taxation agreement with other nations that they do business with. And you will see how they will resolve conflicts between double taxation agreements and the Nigerian tax law. Now, what if you are doing business with a country where there is no double taxation agreement? What happened? Then you'll be seeing active double taxation agreement. That one you will read that on your own because this is something that it's just for your information. Then you'll be seeing Nigerian double taxation agreement. That's also for your own reading because that will not be really tested because it's just for your information to make this topic a comprehensive one. Then we'll be looking at some questions and having solutions to them. So let's go right into the topic. Tax treaty and double taxation relief. Now, what is a tax treaty? A tax treaty is a formal bilateral agreement. So when you say bi means two. If something is bilateral, that means it's made between two people. Now, this is an agreement made between two countries to resolve issues involving double taxation of taxpayers' income, their capital, their estates, and wealth between the two countries. So I'll be using an example now, like let's say Nigeria and the United Kingdom. So it means that if Nigeria and United Kingdom go into a bilateral agreement, it means that any double taxation issues will be resolved between these two countries amicably. So for the double taxation to be binding on Nigeria, it must not only be signed by the Nigerian government, it must also be approved by the Federal Executive Council and be signed by the National Assembly. This is also going to be signed by the people you are also making the agreement with. So you can't be doing an agreement and only one person is signing. No, it doesn't work that way. So there must be a signing to activate these agreements. So now, what is double taxation? How will a situation lead you to double taxation? Now, we remember the last time that we said a taxpayer could be an individual taxpayer or a corporate taxpayer. We are still maintaining that stance that a taxpayer could be both individual or a company. But for the purpose of this class, we will mostly refer to the taxpayer as the company. Now, when a Nigerian company, so we say when we say a Nigerian company, it means this company is incorporated in Nigeria. It's a Nigerian resident company. It may have a foreign branch. It may have a foreign branch. We look at the last time, foreign branch and foreign subsidiary. So we're talking about a Nigerian company now, which may have a foreign branch or perhaps a foreign subsidiary. Now, when a Nigerian company earns foreign income, so if, let's say, Glow Nigeria is earning foreign income because maybe they have Glow United Kingdom, or maybe they are sponsoring another company and they are getting dividends because they are the parent company and the company they are sponsoring is a subsidiary, a foreign subsidiary. So because they are getting money overseas, it means the company earns foreign income. Now, when foreign income is earned by any Nigerian worldwide, it will be included in the chargeable profits for the year and will be subjected to Nigerian tax. This is because a Nigerian company is charged to tax on its worldwide income. Now, in most cases, the amount that will be received in Nigeria would have been taxed twice. How? Let's say Glow Nigeria is the parent company. Now, it's having a Globe United Kingdom. And before they repatriate these pounds that they have made in United Kingdom to Nigeria, the United Kingdom would have first of all collect their tax. As the transaction is going on, they are making arrangement to tax that income. Now that income is also coming into Nigeria. Nigeria will now tax it again. And so the name, double taxation. Now, when an individual or a company is being taxed twice, it will be as though it is receiving punishment for earning foreign income. Why will I be and be made to charge? But if I'm not earning foreign income, I am just earning local currency, I'm doing my business in my country, I will be charged to tax just once. But now I am getting foreign income. The country there, the originating country is charging me. Nigeria, the receiving country is charging me. What is my offense? Now, is there anything that the government could do to cushion the effects of suffering this tax burden, which could be unduly high and also impact on the business? Because taxes is, if your taxes are high, the business will crumble. So it is only reasonable that Nigerian companies should get some relief from Nigerian taxation. So that is where we have Section 44 of the Company Income Tax Act that deals with situations where there is no specific taxation agreement, but you will get some relief. And Section 45 and 46 now cover cases where you have a specific agreement and you will be sure to get a relief. Now we will examine these two taxes, these two sections, or these three sections of the Company Income Tax Act. And it also have some relevant sections in the Personal Income Tax Act, because employees or people who are business names or people who are professionals, they also get to be taxed double taxation. And so there are relevant section that deals with individuals. So now, before we go into that proper, it is pertinent to note here that the tax that you pay to a foreign country is called the Commonwealth tax. So when you see Commonwealth tax, it is the tax payable in a foreign country is called a Commonwealth tax. Sorry, the tax payable in a foreign country is called Commonwealth income tax. Now I will give it a symbol. I will call it Commonwealth tax. Commonwealth tax or Commonwealth income tax. So if you see me use this abbreviation, this is Commonwealth tax. I can also call it foreign tax, FT, but I will most commonly call it Commonwealth tax. So whenever you are paying a tax in a foreign country, that country's tax is referred to as Commonwealth tax. When you are paying a tax in your own country, it is called a local tax. So when you see me writing local tax, if you see me write local tax, I might say LT or I might say Nigerian tax. So these are the two I might use for our own local tax. For foreign tax, you can see me use Commonwealth tax. Now in section 44, subsection 3 of the Act, it says that any tax on income or profits of companies charged under a law that is enforced in any country within the Commonwealth or the Federal or the Republic of Ireland, which provides relief for, who provide for relief from tax charged both in that country and Nigeria in a manner corresponding to the relief granted by this section. So this section is even saying that if there is any business you do and you get income from a foreign country that are in the Commonwealth group and also in the Republic of Ireland, there is going to be something called a Commonwealth relief, Commonwealth income relief. So now let's look at it proper, Commonwealth income relief. So let's look at what it is. Now, Commonwealth income relief. So, wow. Okay, now I choose to call this Commonwealth relief, CWR. Okay, so you will be seeing me writing CWR for Commonwealth relief. Now, when we talk about Commonwealth relief, it says here, where there is no double taxation agreement. So when you see no DTA, so double taxation agreement is called DTA. When there is no DTA, how do we deal with the situation where there is no DTA? Now let's look at it. Now, Commonwealth income tax relief is given in a situation that a company which has paid or is liable to pay tax in Nigeria for any assessment year or any part of its profits has also paid tax to a foreign company or to a foreign country, which is called Commonwealth income tax. In respect of that same particular profit, the Commonwealth tax relief will be applied to that profit that is subjected to tax twice. Now, the relief that will be subjected to that will be enjoyed by the company will be used to reduce the tax that will be paid or payable in Nigeria. So it is in Nigeria, the person is going to enjoy it. So it means that one, you have to be in Nigeria, a Nigerian company, which means you are bringing the pays to Nigeria. Two, it means your company would have been charged tax before bringing it. Or if it has not been charged tax, it is going to be charged to tax in the foreign company, in the foreign country. So that means you are liable to pay the Commonwealth tax. Now, the Commonwealth tax, we have no authority over it. We cannot reduce the Commonwealth tax because we have no authority to reduce their revenue. But because we are Nigerian companies and we are trying to bring a relief to our own citizens, our own residents, Nigeria is going to take the burden of reducing your burden by reducing the tax you are going to pay to Nigeria. So how is it calculated? This is where we come in. We'll look at it in a moment. But the thing to note here is that any claim for Commonwealth income tax relief, which is that cushioning relief that will be used to reduce on Nigerian tax, if you want to claim it, it must be made within 6 years after the end of that year. Meaning that if a company make a profit in 2014, and maybe the assessment year ends in December 31st, 2014. Now that 2014 profit, right, will be subjected to tax in 2015. Is it not so? Yes, this is preceding year basis. Now, between 2015, let's count 2015, 2016, 2017, 2018, 2019, 2020. So by 2021, the claim must be made. So this is because the 2014 income is subjected to tax in 2015 year of assessment. Now, after that year of assessment in 2015, you can claim your tax relief, your Commonwealth tax relief within 6 years from that year. So you count 2016 to 2021. So after 2021, if you cannot claim it, then it is lost. Now, if the claim is admitted, that means it is accepted, the amount of tax to be relieved will be deducted from the tax paid for that year that the claim was admitted. That is for the year of claim, or set against the tax which the company is liable to pay for in the year of claim. Okay, so the year you claim it and it is admitted, the year that claim is made, you use that relief to clear the tax. So it means that if you made the claim in 2020 or maybe 2019, and you are within that your 6 years, and it was admitted and approved in 2020, you have to use it to claim your tax for 2020, not going back to go and claim it for 2014 or 2015. Now, let's go to the place where you will need to master the calculations. Now, the relief available to one Nigerian company. So the watchword here is it must be a Nigerian company. So Nigerian company from tax on its foreign income. So Nigerian company earning foreign income. Now, this is where it becomes tricky. There is no formula here, but we are going to create a formula here. They said, if I will take this place slowly so that you will get it. If the Commonwealth rate of tax does not exceed 1/2 of the Nigerian tax rate, the Commonwealth rate of tax. Now let's see it now. They said the relief available. Which relief that is available? The relief available. All right, Janet is raising her hand. So can I hear you? Janet, can I hear you speak? Janet, I'm waiting for you to speak.
See your screen.
You can't see my screen.
Yes, because my laptop have issue, so I'm using one small iPad here.
So sorry for
So
that. I will
I'm
stop sharing, but you can hear me clearly, right?
yes.
All right, so I will stop sharing and I will share again.
Okay, sir.
I'm getting to the interesting part. You have to see my screen.
Okay, thank you, sir.
You're welcome. So let's share again. You can now lower your hand, please.
Okay.
So that it will not pay you.
Thank you, sir.
Welcome. All right, so in a moment, you will start seeing my screen. Can you see my screen now?
Yes.
Very good. So
which topic are we doing?
sorry?
I said, which topic are we doing?
All right, the topic is double taxation agreement.
Okay.
I hope you know that you're on air. All right. So let's go. Now, we are talking about the relief available to the company. Which relief is that? We have identified that it is called Commonwealth relief. Now, this is Commonwealth relief. This Commonwealth relief is available when there is no double taxation agreement. So Commonwealth relief is when there is no DTA. When there is no taxation agreement, you have a Commonwealth relief applicable. And how does it work? Now, this is how it works. They said the Commonwealth relief that is available to a Nigerian company on its foreign income shall be, what shall it be? Now take note, shall be, can you see here, the Commonwealth rate of tax? So let me write it, Commonwealth tax, sorry, Commonwealth tax, Commonwealth tax. But they gave a condition. If the Commonwealth rate, now say if Commonwealth rate does not exceed, when they say does not exceed, that means it must be either lower or equal to. So if it is lower or equal to half of Nigerian tax rates. So this is a condition for it to be Commonwealth rate of tax. As long as the Commonwealth rate is less than half of Nigerian tax rates, you are going to use the Commonwealth tax rate. So what it means here is that you are going to be looking for Commonwealth rates. You are also going to look for Nigerian tax rates, which we already know as 30%. Then you will now look for half of Nigerian tax rates. Now, when you compare this and this, if this is smaller, then you take the Commonwealth tax because this is going to be smaller. If this is equal to this, that is if the Commonwealth rate of tax is equal to half of Nigerian tax rate, you are still going to use Commonwealth rate tax. But what if this, the Commonwealth rate of tax, is higher than Nigerian tax rate? That's why they now say, in any other case, in any other case, the any other case here means that your WR will be equal to what? Any other case is if CWR is greater than half of Nigerian tax rate. So that is the any other case. Because said does not exceed means it is smaller or it can be equal. But in any other case means it is above or higher. Then we are going to use half of Nigerian tax. So half of Nigerian tax rate. Now, for the sake of arranging it well, I'll put it down here. I'll say Commonwealth income tax relief, say applicable when no double taxation agreements exists. Okay, so the relief, i.e. Commonwealth tax, has two conditions. One, it must be issued to only Nigerian companies. Two, claimable within 6 years after the year of assessment. The relief claimable is calculated odds. Okay. Condition number one, if CWR is less than or equal to 1/2 of Nigerian tax rate, comma, CWT, okay, tax relief, Commonwealth tax relief will be the Commonwealth rate. That's number one. Number two, if CWR is not greater than half of Nigerian tax rate, CWTR would be 1/2 of Nigerian tax rates. Now, the essence is goal. The highest relief should not be more than 1/2 of Nigerian tax rates, i.e., not more than 15%. Because our current Nigerian tax rate here is 30%. So it will not be more than half of Nigerian tax. So it means it will not be more than 15%. So this is the formula we are going to be using. So let's go now and see the example that they gave here. Now they said, if, for example, Commonwealth rates, say 12% and 35%, let's use that example. Let's say example 1. Let's say illustration. Commonwealth rates. They say this is 12%. Then we have Commonwealth rate 2. Let's see what they say here. This is 35%. 35%. Okay, so what is our Nigerian tax rate? Nigerian tax rate is 30%. Therefore, half of Nigerian tax rate will be 15%. So in situation 1, CWR1, here we have half of Nigerian tax rate. We have 12%, we have 15%. So of course, this is less than, or this is less than, not even equal to. So the condition applies if it is less than, if it is equal to. So this is less than this. So therefore, Commonwealth tax relief will be based on the Commonwealth tax rates. To be based on the Commonwealth rates. So that's the first one. That's how that first one is being applied. Now, in the second scenario, which is situation 2, for situation 2, we have the Commonwealth rate, which is 2, and it's 35%. We have half of Nigerian tax rate, which is 15%. So my 5 is funny, which is this is 35, this is 15. So this is clearly greater. So therefore, the Commonwealth rate is greater than half. Therefore, the Commonwealth tax rate will be half of Nigerian tax rates. So we're not going to pay you more than half of Nigerian tax rate. So you see here, in the case here, Nigerian tax rate half is even small. They paid you the smaller one. They come here, they paid you this. So always look out for the smaller one. So look out for Nigerian tax rates, half of it, and the Commonwealth tax rate. Look for which of them is the smallest one, and that's what you are going to pay. So that's the whole gist. Look for the smallest between the Commonwealth rate of tax and half of Nigerian tax. Whichever situations it goes, the smallest one is used as relief. And the highest relief can never be more than half of Nigerian tax rates. Let's go back. Now, section 44, subsection 2 covers non-Nigerian companies. So we've dealt with Nigerian companies. And we say Nigerian companies, we are comparing CWR with half of Nigerian tax, and the smallest of them is to be used. Now, going to non-Nigerian company, let's do the same thing. Let's do our reading. For a non-Nigerian company, now the relief available. So a non-Nigerian company is a company that is not registered in Nigeria, but they are doing business in Nigeria, and they're also doing business outside. Their company is going to take their tax to outsiders, but there are some income that will be charged to Nigerian tax and also charged outsider. But because they exist in Nigeria, Nigeria is going to give them a relief because of being situated in Nigeria. Now, this is different from when it is a Nigerian company. We know they are going to bring the money into Nigeria. But in this case, they are taking the money out because they're not Nigerian, but because they earn income in Nigeria, which is to be charged to tax in Nigeria, and that will be charged to tax outside, Nigeria will compensate them relief. That is what we call the bilateral agreement. Now, they said the Commonwealth relief, okay, the Commonwealth tax relief is going to be what? Let's read it the way we did it. For a non-Nigerian company, the relief available shall be 1/2 of the Commonwealth rate. So here we are saying 1/2 of Commonwealth rate. Remember when it was a Nigerian company, we were using 1/2 of Nigeria. Now we are looking at a non-Nigerian company. We are looking at 1/2 of the Commonwealth rate. Now, what is the condition? If the Commonwealth rate of tax does not exceed the Nigerian tax rate. So you see here, when we are looking at foreign company, we are not looking at half of Nigerian tax again. We are looking at Nigerian tax in full. But now we are looking at comparing Nigerian tax with the Commonwealth rate. And we don't want to give them the whole Commonwealth rate as relief. We want to take half of it as relief. So it's going to be only possible if the Commonwealth rate is smaller than Nigerian tax. Now, the law goes on to say, okay, let me bring it down here.
Somebody is snoring.
Is somebody raising hand or somebody talking? Let me hear you.
I think somebody is sleeping and they're snoring. They should mute their mic, please.
Sorry. Everybody mute your mic so that we will not be getting feedbacks. This is an important calculation, so I'm going to take that again. As I'm writing it down here, I am taking it again. So I'll give it a different color. Now, we are looking at non-Nigerian company. Now, we are comparing the Commonwealth rates versus Nigerian tax rates. Unlike when we are comparing Commonwealth rates with half of Nigeria. So when it was Nigerian company, we are using half of Nigeria. When we are now using non-Nigerian company, we are using the full, but we are going to be using half of Commonwealth rate as a relief. So your Commonwealth, okay, condition number one, let me put it there. Condition number one, your Commonwealth rates of tax will be half of Commonwealth rate. If the Commonwealth rate of tax is lower or equal to Nigerian tax rates. That's what it says here. When they say does not exceed, that means it could be equal to, but it cannot be above, be below. Now, if, okay, they now said the second one. Second one now is the Commonwealth rate of tax will be what? Let's read it this way. The relief available shall be the amount by which Nigerian rate exceeds 1/2 of Commonwealth rate. So when they say the amount by which the Nigerian rate exceeds, that means it is bigger than half of Commonwealth rate. So this is the relief. Nigerian tax minus half of Commonwealth rate. Now, what's the condition? If the Commonwealth rate of tax exceeds the Nigerian tax. So it means that if this is bigger than this. So the moment this is bigger than this, then Nigerian tax will be, you will now say Nigerian tax minus half of the Commonwealth rate of tax. Now, let's see example here. For example, the foreign income of a non-Nigerian company received in Nigeria suffered Commonwealth rate of 28 and 50. So let's look at 28 and 50. 28 and 50. Let's look at situation 3. Situation 3 and 4. So Commonwealth rate of tax 3 is 28%. Commonwealth rate of tax 4 is 50%. So now you know Nigerian tax rate is what? 30%. All right, so for situation 4, we are not comparing the Commonwealth rates. Okay, so this situation 3, Commonwealth rate 3 versus Nigerian tax rates. And so here, this is 28% and this is 30%. So clearly this is lower. And so when this is lower, it means your Commonwealth rate of tax will be equal to half of Commonwealth rates, which is equal to half of 28%, which is 14%. So you see here, care is taken not to exceed 15%. Have you seen that the goal here is to ensure that you don't pay more than half of Nigerian tax? Now look at another example, which is situation 3, is situation 4. Situation 4. We are looking at Commonwealth rate 4 versus Nigerian tax rates. And here we say this is 50% and this is 30%. Clearly, this is greater than that. So your Commonwealth rate of tax will be Nigerian tax rates minus half of Commonwealth rates, because this condition has been met. So this is going to be 30% minus half of 50%. This is going to be 30 minus what? 25. 30 minus 25 is going to be 5%. So your Commonwealth rate of tax here is going to be 5%. 5%. So it means that there is something here. If the Commonwealth tax rate happens to, the higher it goes above the Nigerian tax rate, the higher the Commonwealth rate of tax, the smaller the relief you are going to get in Nigeria. Now imagine a situation where the Commonwealth rate of tax is 60%. Let's imagine that. Let's create a situation 5. Commonwealth rate 5 is 60,000. Nigerian tax rate is 30,000. So you see here, Commonwealth rate, Nigerian tax rate, we have 60, which is clearly greater than 30. And so your Commonwealth rate of tax will be 30 minus half of 60, which is the same thing as saying 30 minus 30, which is 0. So it means that if your Commonwealth rate of tax is 60%, you are getting 0, nothing from Nigeria. And if it exceeds 60%, you are still getting nothing. Anything from 60% and above, you will get no relief from Nigerian tax. But if it is anything, the only way that from 31%, if your Commonwealth rate of tax is 31%, it's just 1% difference. Okay, somebody's raising hand. Okay, please raise your hand. Speak.
Yeah, thank you. I just wanted to clarify. When we are talking about Commonwealth rate tax, you're talking about the tax rate for that particular country, right?
Yes, the tax rate for that country.
Okay. Thank you.
Okay, so if the tax rate for that country is 60%, you are not going to get any relief from Nigeria, because Nigeria, you have been taxed high there, and they're not going to give you any relief here. But if you are taxed lower than 60, between 31% to 60 to 59, you're going to get something. So the highest money you're going to get is when you are taxed at 31%. At 31%, okay, Tosi, your hand is up.
Yes, sorry. I'm sorry. Just one more question. So, although we have not gotten there, but as we are going ahead, I just wanted to just ask. So, in that case, say where we have 5%, which is a tax relief, let's say the amount that is calculated for tax is 30% of that income that has come into Nigeria. Say, for example, say the amount that has been calculated for tax is 500,000. So they take 5% of it right away.
What happens is that they will take 5% of the foreign tax as your relief. It means that whatever you have been charged as tax, they will take 5% of it.
5%, okay. But they will still use 30%, right?
In
For the
Nigeria, they will use 30% to charge your tax,
okay.
and they will get the value that they will be charged to tax. Then they will now bring the 5% to
Okay.
lower the relief.
Okay. All right.
So if you want to get the greatest benefits, it means that your tax has to be 31%. Okay, if you look at 31% now, let's just look at 31% from calculator. 31% is bigger than 30%, isn't it? So half of 31%, 31% divided by 2 is 15.5. So if we say 30 minus 15.5, it means you're going to get 14.5 as your tax relief. Nothing should be more than 15%. So 14.5% is your relief. Nigeria gets to enjoy only 5%. But assuming instead of 31, you now do 29. Because, okay, let's say you now do 30. So your Nigerian tax rate and your foreign tax rate is the same, 30 and 30. So if it is 30 and 30, that's the highest you can get. So it means half of 30 is 15. So it's going to be 30 minus 15. No, it's not even going to be that. If it is 30% that you are using, what will happen is the same thing, yes, 30 here minus, no, it's going to be half. If they said if it is, doesn't exceed Nigerian tax, so that means it is the same, 28 or even 29. Look at 28, you are using 14. 29 to be 14.5. Of course, 30 is going to be 15. So that's the same thing. So whichever way you look at it is the same thing they are giving you. If you are using 30%, you could calculate here, you will get 15, which is half of Nigeria, half of foreign tax rates. If you use this same method, you are still going to get 15. If you use 28 here, as we use here, you get 14. If you use 32, you are still going to get 14. This is because the difference between the CWR and Nigeria is just 2. Whether it is 2 lower or 2 higher, you are getting the same rate. So that's what we are telling you here. So you need to remember these formulas because they will not be given to you in the exam. All right. All right, so let's go where there is double taxation agreement. Now, before I proceed now, if you can remember when you are learning financial accounting and you learn about partnership business, and we usually say there is partnership agreement. So double taxation agreement, partnership agreement, right? You have a partnership deed. Then if you have a problem or you are sharing income or so, but there is no partnership agreement and you are going into business and the business will be turned sour, the law says that when there is no partnership agreement, there are certain things that the partners will gain so that they will not be left out. That's the same principle we are using here when there is no double taxation agreement. If no double taxation agreement exists, instead of just allowing the person to bear the tax burden that way, we are saying here that you will enjoy relief from Nigeria at no more than Nigerian half of Nigerian tax. Your relief can never be more than 15%. But what if there is an agreement? Do you think you stand a chance to getting a relief more than 15%? Is that possible? Let's see whether there is going to be a better chance if there is a relief. Now, the provision of the law states that where there exists double taxation agreements between one country and Nigeria, now take note here, the amount of relief available will be computed on the basis of the provisions 45 and 46. All right, so what are the provisions? Let's take them here. Note, the provisions of section 44 shall have no effect. What is section 44? Section 44 deals with where there is no taxation relief, double taxation agreement rather. Section 1, subsection 1 covers Nigerian companies. Subsection 2 covers non-Nigeria. Now, where there is a double taxation relief, then CWRO has no effect. Now, Commonwealth rates has no effect. So this Commonwealth stuff is for section 44. And so instead of using CWRO, we will be reverting to something called foreign tax. So you see, I told you that I'll be using foreign tax. Now, when I use foreign tax, it is when there is DTA. If I were to use CWRO, it is when there is no DTA. Take note. Now, foreign tax means any tax payable in a country under the agreement, which under the agreement is to be allowed as a credit against tax payable in respect of those profits in Nigeria. So take note, foreign tax means a tax payable which under the agreement is to be allowed as a credit. So it means it's possible that all the foreign tax is to be allowed as credit. It is possible that all the foreign tax is to be allowed as credit. But here, in the CWRO arrangement, it's either 1/2 of Nigerian tax or 1/2 of foreign tax, whichever is smaller has been allowed. Now, they said the tax payable on the worldwide income will be reduced by the credit admissible under the term. So the tax you are collecting on your worldwide income Now, when we say worldwide income, it means it's only for Nigerian companies. So in the case of CWR, where we have when there is DTA, you stand to benefit it if you are only Nigerian company. So now you see here, the tax payable on the worldwide income will be reduced by the credit admissible. And now the last, see the last, okay, no, not the last. It said the total credit to be allowed for the foreign tax for any year cannot exceed, now that is the point I want to say, cannot exceed the total tax payable by the company for that year in Nigeria. So it means that it is possible that you can use all your Nigerian tax as relief. It is possible that all your Nigerian tax will be granted as relief. There is no way Nigeria will now make a refund of your foreign tax. So what it means here is that, so this year is the law coming now. If the foreign is lesser than Nigerian tax, then your relief, okay, I will not call it Commonwealth relief, I will call it double taxation relief, will be the smaller of the two, to be the foreign tax. Now, if the foreign tax is now bigger than the Nigerian tax, your double taxation relief will be your Nigerian tax. So it means if this is 20 and this is 30, your double taxation relief will be 20. Now, is it not higher than Nigerian tax? Half of Nigerian tax is higher than 15%. Now, if this one is 35 and this is 30, the DTA will be 30. So can you now see that with DTA, more than 30, with DTA, more than 30%, you will not pay more than 15%. I'll take it again. With pay more than 15%. So that, or with DTA, you will not pay more than 30%. So that 30% or lower. So whichever is bigger now, which one is bigger now between double taxation agreement or Commonwealth relief? It is double taxation agreement. So it pays for Nigeria to have double taxation agreement with some countries. Now they said here, a company can elect not to take the benefit of the credits available under arrangement in respect of the foreign profits earned by it. So you'll be surprised that there may be some conditions when you look at the conditions and you tell yourself, okay, it's better I don't take the double taxation benefits. Any claim for an allowance by way of credit shall be made not more than 2 years. Here, 2 years. As against CWR, that is 6 years. In the event of any dispute as to amount allowable, the claim shall be subject to objection and appeal in like manner. So now you see here that your goal here, your goal is 30% or less. So I will want to put it down here. Let's take it down here. When double taxation agreement exists, then we'll say CWR no longer applies. Hence, CWR is replaced by foreign tax. All right. We'll now say when the foreign tax is less than or equal to Nigerian tax, your double taxation relief will be foreign tax. When it is less or equal to Nigerian tax. That's number one. Two, when foreign tax is greater than Nigerian tax, so DTR will be Nigerian tax rates. I'll put the rates, and rates. So goal is to relieve at no more than 30%. So that's a relief. All right. So a tax treaty, which is also called a double taxation agreement, we said is a bilateral agreement. So it means the two countries will sign it. And we have talked about this. It must be signed, approved by the Federal Executive Council and be ratified by both the National Assembly and that of the Senate. Features of the double taxation agreement relief. Here are some of the features. The names of the two countries involved will be stated together with definition of residents and what is a resident person or resident company. The definition will be clearly defined there and the persons that are affected. The rates of tax applicable in the two countries will be stated with a caveat that the rates may be changed without notice. That's another thing there. Then the next one would be the transactions on which the double taxation agreement or relief will be applicable will be stated. So it means that if your transactions are covered in that definition, then you can apply for double taxation relief. Then the arrangement for the exchange of information between the two countries will be shared. This is to avoid the incidence of tax evasion. So it means that if you are going into double taxation agreement, it means you will share information. The two countries will share information. Let's say Nigeria and UK, they share information about taxation, changes in taxation, so that if the people of the company in UK owned by Nigeria is doing something, the UK people will be aware, okay, this is against Nigerian tax law. It is possible that as he's contravening that, they will report him to Nigerian authorities so that appropriate sanction will be given, so I will not be evading tax. And if there is also a UK company in Nigeria doing business, the activities of that company will be shared with the UK so that incidents of tax evasion be minimized. Then there is procedures for tax disputes. Then the available diplomatic privileges for taxpayers. You can read all of these things at your own time. So now, double taxation agreement with the UK. I'm not going to teach this. This is something you are going to read at your own time. So this is spelling out the double taxation that Nigeria have with UK. Then what are the impacts of or benefit of double taxation? One, avoidance of double taxation. So this agreement will avoid the company paying tax twice. Then it clarifies the taxing rights of each contracting state. It means that which of the states has the right to tax. The state that has the higher tax rates have more rights to tax, because if Nigeria is giving 30% and maybe UK is giving 20%, it means that 20% will be relieved here in UK as if, relieved here in Nigeria, as if you didn't pay anything in UK. And it's only going to be paying only 10% in Nigeria. But if he's paying 35% in the UK, Nigeria will remove the 30% that it can only grant. And it's as if Nigeria is not even taxing him. And it's as if he pays only 5% in the UK. That is how it looks like. Right? So the whole thing is this. It means that it's as if he's paying only one country's tax. It's as though he's paying only one country's tax, which is the tax where he gets the higher rate. The country where he gets the higher rate. Now it's encourage economic cooperation between states, prevent fiscal evasion and anti-avoidance provision. And there's a lowering of compliance cost. These may be asked. So we're not going to be talking about resolution of conflicts, and we're not going to be talking about active double taxation, but just look at it here. We have, these are countries in which Nigeria have double taxation agreements with. I don't think it has with USA, but it has with Canada, has with China. So look at the likely business partners of Nigeria. I didn't see the United States. All right. Now, implications of double taxation agreement on withholding tax deduction. Now, a company resident in a country that has no double taxation agreement with Nigeria will suffer withholding tax deduction at the rate of 10% of the value of the revenue from dividends, interest, and royalties, while those from double taxation treaty will suffer withholding tax deduction on similar income at a reduced rate of 7.5%. Then we'll look at some definitions here. What is a unilateral agreement or relief? Now, this is a relief granted to mitigate the effects of international double taxation on the basis of domestic legislation rather than the provision of a tax treaty. So, well, let me not bore you with these words. These are mostly things that there's a high chance it may just only come out in just list or explain or write short notes. You can read that. We've talked about permanent establishment, so I will not want to say it here. Okay. Let me go to where okay, let's see taxation of investment income. Now, dividend derived from a company which is resident which is a resident of a contracting state by a resident of another contracting state, may be taxed in that other state. However, such dividends may also be taxed in the contracting state of which the company paying the dividend is a resident according to the law of that state. You know, residency can have different meaning to different countries. One will say residence could be by management, one could be by domiciliary. But where the recipient of the dividend is subject to tax thereon on the other contracting states, the tax so charged shall not exceed 12% of the gross amount of the dividend if the recipient is a company which controls directly or indirectly at least 10% of the voting power or 15%. So it's either 12% or 15%. This hardly comes out in the exam. What really comes out in the exam is what we have discussed, the double taxation relief possible. The dispute is just like any other dispute that we're going to treat when we talk about disputes. Okay, so we've seen the major things we've seen here is tax treaties and the concept of double taxation relief. We looked at it in the concept where there is no double taxation agreement. We looked at when it is a Nigerian company and when it is a non-Nigerian company. Then we looked at it where there is a double taxation agreement and it's only beneficial to Nigerian companies. Now we looked at some of the countries that have double taxation agreements with Nigeria, which you are going to look at your own time. Now let's look at a question. John Ogu and Co. Limited is a firm of medical practitioners with clinic in Lagos. In 2017, the operations of the company was extended to a neighboring Commonwealth country. Now, there are certain things you'll be looking out for you to know that this is a double taxation question. One, you've heard of the word Commonwealth. So you start thinking, is it possible that there is no double taxation agreement? Then you're now going to check, is this company a Nigerian company? Look at it again. John Agul is a firm of medical practitioners with a clinic in Lagos. So it's possible it's a Nigerian company. They said the operations of the company was extended. So that means this is the head office, headquarters, Lagos. They now extend to a neighboring Commonwealth country. Now you are saying foreign clinic, Lagos clinic. So this is the headquarters. And this is the foreign. And now this is the total. So it means that as they are consolidating, they are bringing the Lagos clinic, they are consolidating it with the foreign. Where will they be consolidating it? So it means that the total is Nigeria. Can you see it is in Naira, which is the currency of the reporting currency, where they are consolidating the account to. So what can we do now? Now we have fees. Now look at the income. Because this is a medical practitioner. So this is fees. This is allowable. This is sales of drugs, allowable. Okay, so these are your income. Now look at your expenses. Salaries is allowable. Electricity and rates, allowable. Motor vehicle maintenance, allowable. Depreciation of assets, disallowable. Purchase of drugs, allowable. Bank charges and interest, allowable. Now hold on. Taxes suffered. Now, while this is allowable, we are going to pretend as if we are disallowing it. Now, watch how I say it. Foreign tax suffered is allowable, but we shall pretend that we are disallowing it. There is a reason why we are doing that. We want to get what we call our chargeable income. We want to get our chargeable income so that we will use that to find the foreign tax rate. We were not giving the foreign tax rate. We are only giving the foreign tax. How can we get our foreign tax rate? It is to calculate what our chargeable tax, what our chargeable income will be before we suffer the tax. So we want to go to a situation where, okay, this is our chargeable income. It is from this income now we shall now charge tax. The only way we can do that is to treat this one at first as if it was disallowable, as if we have not allowed it first, so that we will get to that position where just before we allow it, what is our chargeable income? So that we use it to know the percentage. So that's why I'm marking this one at the back here, that it's allowable, but we are going to treat it as at first as if it is not allowable. Then miscellaneous expenses. This is vague. We'll look at the additional information to see whether there's anything about it. Now, profit is this. Of course, this profit is going to be adjusted. Additional information. Capital allowance. When I hear capital allowance, I may not want to read any further. I know they are allowable. Okay. Then the company is a holding Nigerian company. This is all I know. So now, miscellaneous expenses, we are not told if it is allowable. They didn't give us anything, so let's allow it. Let's allow it. All right. Now, we are required to do what? Compute the income tax liability of this company for the relevant year of assessment, stating clearly the double taxation relief applicable to the company. So what we are going to do here is John Argo and Co. Limited. This is worked example. Example 1. John Argo and Co. Limited. Is it limited? Or company? Yeah, limited. Now, which year of assessment are we discussing? Because 2017 is the year in which the operations were made, so it's going to be 2018 year of assessment. So we're looking for double taxation relief and income tax for 2018 year of assessment. So what do we do? What do we do? So this is total. And now the total is Nigeria. This is foreign. And this is Lagos, still Nigeria. Everything is in Naira. Everything is in Naira. All right, so what do we do now? Let's start with the profits. This is the profit that we are given, which we are going to adjust. Net profit as per statement, is going to be what? 575. So this is 575 in Lagos alone. 3168. 3168,000. But we have to add them together. This should give me 37. Let me just write it here. 3743. 3743. That's the total. All right. So let's add backs. So it's not only the disallowable we are adding back. So we'll just call this on add backs. We have depreciation. How much is the depreciation here? It is 145,250. 145,250. So this is 145,000. And this is 250,000. And this is 950. So everything here, what am I doing? Yes, Tosi, that's 395. Ask your question.
Yeah, sorry, I just need so in terms of when we did, sorry, I'm taking us a bit back. I'm just trying to link everything together. When we did special business, that was when we had to that's where we had to talk about companies that that are engaged in um shipping and telecom. That's where we talked about the non-Nigerian company and the likes. And that was when we had to calculate worldwide income, where we identified allowable expense. And also in this case, this what we're doing now, because I can see that you identified the allowable. So what I wanted to just ask is just that generally when we are calculating worldwide income, do we also take consideration of all this allowable expense and all, like just like you introduced to us when we did special business? Is it like a general thing that when you're calculating like a company that has a subsidiary outside Nigeria, and when we're trying to determine their worldwide income, do we always take into consideration allowable and disallowable?
Yes, every company, both special business, Nigeria, non-Nigeria, we need to look at allowable and disallowable.
Yeah, but this particular company now, it's a clinic. It's not part of, it's not classified as special business.
It's not a special business, yes.
Yeah,
So,
but we still take into consideration that.
yes, that's why I said it doesn't matter whether it's special business or
Okay.
normal business. You must consider allowable and disallowable.
As far as it's a worldwide,
As long as
right?
it's not a worldwide, even if it's a normal business that is not worldwide, you still consider allowable and disallowable. Even if it is a business that only exists in Lagos,
Okay.
you will consider allowable and disallowable. If it has
Yeah, and
branches,
which I remember that you said as long as we can argue it's like it's based on our discretion, right?
no, it's not based on discretion. There are a list of things that are allowable, and there are things that are not allowable. Now, the one that you need to argue out is if it is not clear.
Okay.
If it is not clear whether you are classifying it as allowable or disallowable. But if it is clear, for example, depreciation is so clear, you cannot allow it. Any expenses of a capital nature, they are
Yeah.
not allowed. So it is stated, in the taxation world, it's a worldwide norm that these things are not allowable. So one of them is depreciation. So now, why am I adding back depreciation? This is because it has been deducted already. So I'm using the net profit method. I am not coming from the, okay, if I were to come from the beginning, I would have written all of this. I would have allowed this. When it comes to depreciation, I will not touch it. And when it comes to tax, I will not touch it. But I'm starting from the bottom, going up. So this depreciation has been deducted already to get this profit.
Okay, sorry, one more question. Sorry. So when we are calculating income tax, any expense that is capital in nature is disallowed. And
Yes.
when we are doing capital gain tax, because I remember you saying what is allowed in income tax is disallowed in capital gain.
So all of these things here, salaries, electricities, and for income, they are not allowed for capital gain.
Capital gain, okay.
It is only the capital nature that's allowable. Of course, depreciation too is not allowable there.
Intact capital gain.
Yes. All right, so now we are adding back depreciation because it was not supposed to be deducted. Then the next thing to add again, we said we are going to add foreign tax. Why are we adding the foreign tax? We want to get the situation we were before we charge our tax. So we're going to add it. So let's come here. Foreign tax suffered. We're adding it back temporarily. This is going to be 1510. So this is Lagos. Lagos didn't suffer it. 1510. So this is going to be 1510. So let's add. This is going to be our adjusted or accessible profits because there's no loss relief. So this is going to be our accessible profits. So let's check that of Lagos. That of Lagos is 575,000 plus 145,000. That gives me 720. So I'll put my 720 here as my accessible profit. Then I will look at the foreign company, the foreign branch. So 3,168,000. Sorry. 3,168,000 plus 250,000 plus 1510,000. That should give me 4928. 4928. 4928,000. I want to do something now. 4928. If I add 720, that should give me 5648. 5648,000. Let me confirm if what I wrote here was correct. Let me start minusing if I will get the last figure. Minus 1510,000 minus 395,000 3743. So it's correct. All right, so this is my assessable profit. Now, before you calculate your tax, normally, before you calculate your tax, you would have gotten your capital allowance. Capital allowance. Now we are told that the capital allowance allowed with the federal inland revenue is how much? 1,450. So it means that here is going to be 1,450. So now if this is 1,450, how much will this one be? And what will be put here? So let's calculate. How do we calculate our capital allowance? Let me use workings here. Let me say workings. Okay, before I do the workings here, after your capital allowance, you will have your total profits. It is this total profit that you are now going to be charge your company income tax. So now
That guy.
Sorry? Someone talking? So the first thing to calculate here is our capital allowance that we are going to be put in all these ones here. Capital allowance. We are going to use the depreciation value as a proration for capital allowance. Look at the depreciation. So this plus this gives me this. 145, 250 give me 395. So let's do something here. For Lagos, Lagos is going to give me what? Lagos got 145. So it's going to be 145 all over how many here? 395. 395. Whether you put 1,000 or you not, doesn't matter. Multiplied by 1,450. But with this one, you put the whole thing complete. So this is for Lagos. This is for foreign. Foreign is how many here? 250. So you can say 250, whether you put the whole 250 or put the 250,000 all over 395,000. The reason why I remove it here because I can remove these zeros and these zeros. That's why. So why I'm doing it differently here is so that you will be wondering, why did I put it without? I can show that I can remove them times 1,450. So let's do them one after the other. Sorry. Calculator is what I want to use here. I can say 145 divided by 395 multiplied by 1,450,000. That gives me what? 532,278. 532,278. 532,278. 532,278. So let's just write it down here. 532,278. So let me just immediately get the total profit here. I have 720 minus 532,278. That gives me 187,722. All right, so now let's look at that of the foreign. I have 250 and put the whole 1,000 if I like, divided by 395. As I've put the whole 1,000, I have to put the whole 1,000 here now, times 1,450,000. That will give me 917,722. 917,722. 917,722. So I'll write it down here. 917,722. If you have to add these two together, you are going to get, let's do it now. 917,722. If you add it with 532,278, you're going to get 1,450. So now let's calculate these at once. So I have 4,928,000 minus 917,722. That gives me 40,10,278. All right. Then let's do the combined. So we have 5,648,000 minus 1,450,000. That gives me 441,98. Now, take note. This side of the Lagos is not important now to us. What is important at this point here now is this side, the foreign, and the total. This is because Lagos is in Nigeria, and everything here, both the foreign and the Lagos, is done here in Nigeria. So the tax that will be paid here is also seen as also being here. So this is of no importance anymore after getting your total profit, after getting adjusted profits and capital allowance. In fact, this is from here now, it's no longer. So what we'll do now is company income tax. Company income tax. So let's do something here. Company income tax. Let's say foreign tax. How much was the foreign tax that we paid? We are now bringing it now, 1510. So this is 1510. This is your foreign tax. Company income tax, Nigerian tax, which is 30% of 4,198,000. So 4,198 times 0.3. That gives me 1,259,400. So 1,259,400. 1,259,400. And I will say less double taxation relief. So whatever we have as our double taxation relief is going to be here. So it means this is company income tax payable. So now let's look at it now. We don't know, we are not going to be using the figure. We want to know the rate that was used in calculating this. We already know the rate that used in calculating this. The rate here is how much? 30%. So the next thing we are doing is foreign tax rates. Now, our foreign tax rate is going to be foreign tax paid or payable all over total profits. Now times 100%. So you see now, why we have to calculate this total profit by removing the foreign tax. We remove the tax first so that when we get our total profit, it's from this total profit that this tax emanated from. So you see why we have to remove it first so that we can get this. So this is 40,10,278. So this is going to be 40,10,278 is going to be 1,510,000 times 100%. So let's see. 1,510,000 divided by 40,10,278 multiplied by 100. So that gives me 37.65%. So this is 37.65%. So because we have 37.65%, so foreign tax rates, Nigerian tax rates. So this is going to be 37.65%. Of course, it's greater than 30%. So the lesser is the double taxation agreement because there's an agreement here. Company says here that it's a Nigerian company. There was nothing here that says double taxation agreement exists. If there's a double taxation agreement existing, they will say double taxation exists. But if you can't find anything and you are seeing Commonwealth, then it means the Commonwealth rate of tax. So now I will not change this instead of calling it foreign tax or call it Commonwealth tax. Instead of calling this of Commonwealth tax rate, Commonwealth rate. Okay, so what I'm going to do now, because this one is greater than, okay, so this is a Nigerian company. Of course, I'll be looking at half of Nigerian tax. This is 15%. So this is greater than 15%. So when it is greater, the Commonwealth rate of tax will be at 15%. So what we are going to do now is we are going to look at the income you get. The Commonwealth, the income, we got income here. The income we got here was 40,10,298, 278, 40,10,278. Forty, 10,278. So the Commonwealth tax relief will be 15% of 40,10,278. So 4010278 times 0.15. 0.15, which is 15%, 601,542. 6,542. So you're going to be 601,542. So that's what we are going to use here. We're not going to, out of the foreign tax, we're going to pay 601,542. That is what will be reducing our Nigerian tax. So 601,542, I will not take it from 1,259,400. So your double tax is the tax you are going to pay in Nigeria is 657,858. 657,858. So take note, you are paying 657,858 in Nigeria. You are paying 1,510 in the foreign company. So these are the two taxes you have paid. So let's see, your total tax would have been 1,510,000, which you paid in foreign, and the one you paid in Nigeria to be 2,167,858. So that's the total tax you would have paid. But you would have paid this part of the tax in the foreign, but coming to Nigeria, you are paying this part of the tax. All right, so we are past our closing time. So I want you to look at this topic again. Look at the question in the light of what we've discussed here and try to solve as much as you can. Note here that the goal for Commonwealth rate of tax when there is no double taxation is to spend no more than 15%, which is Nigerian rate, applying it on the foreign tax income and using the value to reduce the Nigerian tax. But if it is more than the Nigerian tax or half of Nigerian tax, you take half of Nigerian tax rate. That's the rate you're going to use to go and look for the proportion of the foreign income and less it from the Nigerian tax. We said about double taxation agreement when it exists. We are going to look at the lower rate is used as the relief. The lower rate is used for the relief. So that's it here. If you have any question, please feel free to ask me. Our time is well spent and we have come to the end of this topic. In our next class, we'll be discussing another interesting topic that will likely see in your exam. So please practice, practice, practice so that everything we've learned here will stay put in your head. So until I come your way in our next class, I remain your humble teacher, Chimaroke. Good night.
Nice.